I guess this means we are live, hopefully. So if that's the case, then I want to welcome everyone to next episode of our SaaS Lounge. I think it's episode number 5. And this time we are co-hosting with Semper because we have a topic that is close to the hearts of us and Semper as well, and that is secondary buybacks of employees. So I would try to very quickly introduce the guests on our SaaS Lounge today. So we have Matthias Pastor from Semper. Just maybe if you could just a few words about what Semper is doing and who you are.
Yeah, so we'll get a chance to dive into more detail, but I'm Matthias Pastor. I'm one of the co-founders here at Semper, and what we do is that we partner with private companies in their market, in particular with regards to the shares they give to their employees.
Excellent, thanks. Then we have Stephen Rosen from Cooley.
Thanks, Lucas. Stephen Rosen. I'm a corporate partner at Cooley, a US law firm based in London. We help companies, predominantly tech and life science and healthcare companies that are either taking or taken venture money or fundraising, growth capital money, and then help them through their various stages of growth and hopefully help them to IPOs and successful exits.
Great, yeah, thank you. And then we have David Aber from Guesty. David, I think at least for me, I've lost the video of David, but hopefully at least we will be able to hear David. Yep.
You don't see me?
I don't. I'm not sure if that's just me, but I don't. Oh,
that's weird.
Now we see you. Perfect.
Hey, so Lucas, thank you. My name is David Aber. I'm the CFO of a company called Guesty. Guesty's developed an end-to-end software platform for managing short-term rentals. We're located in 15 countries. We have listings of short-term rentals in 80 countries. And I'm happy to be here today. And thank you, Lucas, for inviting me.
Excellent. Thanks for coming. And my name is Lucas Harustiak. I'm one of the partners in Flashpoint Secondary Fund. So Flashpoint is an investment manager investing in tech companies that are founded by entrepreneurs coming from Central Eastern Europe and Israel. And the Flashpoint Secondary Fund is focusing on basically secondary transactions. That means buying existing shareholders, including employees of those companies. So coming to our topic. So I guess where it all starts is about aligning of interests, right? There is a lot of talk about aligning of interests between investors and the management and the company, right? And one of the ways how to basically solve it, or that even let's say what investors like to see a lot, is to have a ESOP plan that actually then like a big part of the employees' compensation is an ESOP. So the value of the compensation grows with the value of the company, at least in theory. Kind of like that should be, let's say, everybody's goal, and everybody wants to see that value increasing over time. And the theory is that basically this should motivate the employees to work harder, be loyal, stay more basically work towards the same success as the investors want, basically to grow the value of the company. But I guess the question is, do these ESOPs really work, right? Do they really provide the right incentive? Do they actually motivate employees? And do even employees understand the ESOPs? Do they understand the value of them? And without going, the purpose of this call is not to go into the technical details of the ESOP in terms of how should they be structured and who should get the ESOP and basically how should the shares vest. But it's more like, is there a kind of like a fundamental, let's say, underlying principle in ESOP that is working or that is not working, and that is that ultimately ESOPs are options in private companies that by itself are illiquid. So basically, is that illiquidity that is actually impacting even the value perception or the value understanding of employees of the options that they have, and does that by derivative kind of impact their, in a way, let's say the first plan, which was the incentivization? Because we've heard from founders that it pains them to basically in a way, basically give out the equity in the company, only to see that the employees do not value it at all, right? Because ultimately, company equity is the most valuable currency that the founders have, and they give it out to people in order to motivate them. And therefore, when they see that actually it does not provide that function at all, it really misses the purpose. And now the question is, can the illiquidity of this be an issue in that whole, let's say, value transfer? So I guess the first question is that, because obviously the way to maybe solve it is to create that liquidity. That means to allow or even encourage employees to sell down those shares, or basically sell down those options. So I guess the first question is a very fundamental one. Should companies be doing that? Should companies be looking at that, right? I guess maybe I'll first ask Matthias, because he's clearly biased in this sense, since he's created a platform in order to enable that. But still, would want to hear your views, Matthias.
Yes. So my bias is pretty explicit. We help private companies run secondary transactions. So I would be hypocrite if I do it. I would qualify what I'm saying though a bit. So I think initially illiquidity, private companies was very much a feature and not a bug. Companies staying private for 5-6 years and then going public, and so we expect the people that were to be committed for the long term, in the sense the company does well, they'll be rewarded down the line. Nice exit. What's happened 10 to 15 years is that companies have stayed private. 2021, we saw a lot of IPOs. 11 SPACs were taking 4-year-old companies public. Anomalies from 2021, the median was probably going to be even higher. And whereas public after 5-6 years, it would have made sense to be committed for that amount of time. I think liquidity has become a bug of private companies. And so the question becomes, what do companies do about it? Do they let the secondary market evolve in a kind of gray fashion where they don't control who's selling, who's buying, in what conditions they're selling, what information is shared in the process? Or do they, kind of face the fact that this is going to happen with or without their consent, really, in different forms? And we're very companies with the topic because it's an opportunity to be more proactive. As you mentioned, Lucas, I think the best way to make equity available to everybody is some partial liquidity on it. I'm not going to another hour, but David has a very different opinion. Curious to get both David and Stefan's point.
Yes, so David, from the point of view of company or the company CFO. You're on mute, David, I think so.
So I hear what Matthias is saying, and employee stock option plans came into effect around 25 years ago. They started to become popular, and every tech company started to issue them. And I'll just say, my dad worked in the same place for 40 years. This has changed since then. And today, employees move around. But in the olden days, we used to call ESOP the golden handcuffs. And employee retention, part of it was employee retention. I don't like to think about the ESOP plan as ongoing compensation for the employee. I think it's really important that the employee share in the upside of the company, and I think it keeps them focused on that. But I don't want to lose sight of the original idea of the ESOP, which is employee retention, attracting great people who believe in the company, but we want to keep them to stay as long as possible. Having said that, it's really, really difficult to explain to employees what the value of their options are, especially young employees who have not yet participated in any type of a liquidity event at any company. The value of the option is it depends on how the funds were raised. It depends on the preferred shares. It depends on the structure, and it's almost impossible to explain to an employee. And most companies don't want to explain to an employee what the value of their option is at the time they bring them on board. So, having said all that, I do believe that after a number of years that an employee is in the company and pressure is starting to build, if we wanted to show him or her the value of those options, it's important to release some of that pressure and let them participate in a secondary event. I think there's a difference between allowing and enabling. So I'm a very big fan of secondary events that happen in parallel or in tandem with a primary event. And I think we'll get into details of that later when we talk about the structure of how a secondary.
Yeah, thank you. Stephen, your view, obviously you are maybe more of an executioner of these things, but still, it would be also interesting to hear the views that you have gathered over time of basically dealing with the varying parties in the processes.
No, definitely. I mean, I think that there are two sides. Obviously, there's sort of the business considerations and the legal considerations, and we'll get into a bit of the legal detail later on as we go. I think David's sort of right, but maybe just to sort of summarize in a slightly different way. I think sort of if you look today at where sort of the modern employees are for the companies that we're talking about, particularly SaaS companies, there are sort of three ways that people use options. One is whether you like it or not, it's an alternative to salaries. So options in some senses, and certainly from a US perspective, you would argue that options are actually seen as a cash shortfall problem rather than as an incentivization, because the reason you give out options is because actually companies don't want to use their cash, and it's a great way for companies to not use cash. I think the retention piece, I think we all agree that there is an element of retention for key people. I think the difficulty we've seen over the last few years, certainly, and certainly if you look at some of the bigger tech companies and some of the problems we've got into with RSUs, one of these issues is that the breadth of people that have ended up picking up options is now so broad that actually they've almost lost sight of this idea of retention, because the junior employee who gets a small amount of stock options really, as David said, really struggles to put any quantifiable value on it. So I think the breadth of the stock option pool has sort of become more challenging. And then I think there's this sort of commitment to building, I would say now, medium to long-term value. I think companies on an aggressive growth strategy, I think it's much harder now to justify those sort of stock options. But I think, as Matthias said, this idea that companies are going longer means that companies need to I like what David said about alleviating the pressure, because I think that's what happens. I think because the companies are going longer, the promise of jam tomorrow or honey tomorrow, whatever your phrase is, it loses value and it loses emphasis and focus the longer you go. So after 10 years, this idea that you might one day get the golden honey pot, just people don't have any value around that. So I think ways that you can do this on a coordinated basis, and I think, as we'll see as we go through the questions, that the world has become so complicated now. Yes, we're so much more joined up and we're so much more connected, and it's so much easier to have options in different geographies. But actually, one of the challenges is that it's so complicated, as David will know in too well. By the time you get into a tax and accounting issues, and then regulatory requirements, I think the idea that you can just let employees do this on a sort of ad hoc basis is probably quite tricky without it ending up in a real nightmare for companies ultimately. So I think almost by default, you sort of end up having to be coordinated about this and having to be organized, because otherwise the risk is you do something which actually then causes a problem further down the track, which you've seen a couple of times, and we can talk about that as we talk about maybe some blockers later on.
Yeah. Thank you. Yeah.
Thanks a lot for that. Obviously, we'll be able to react on as we go through
going from the other side
of the prism, which is the investor angle. And I think it was one of the things that you were hinting at, David, as well, and would be great to get your take on it, Lucas, is obviously for a long time, secondaries had a bad reputation because of the signaling aspect. So, it's at the end of the day, it's insiders that are selling their shares. And so I'm curious to know, David, you mentioned you liked it as part of the primary. Lucas, your fund is focused on buying secondaries, and so you're dealing with this signaling / adverse selection question all the time. So it'd be great to answer that question.
Yes. So, signaling is a great question, and I think it's also part of the reason why, in a way, secondaries have not become a mainstream yet, and why. In a way, we even have this question that basically should the companies enable employees to sell, right? Because every time when basically somebody sells something, there's an implicit question, well, why is he selling or why is she selling, right? And basically on the surface of it, when people are buying, it needs to be a good thing because people want to buy it. If people are selling, it needs to be a bad thing because people want to sell it. It's kind of like if you see a queue in front of a shop, well, you join it because surely they have something very, very good that also you want to buy, right? That's kind of like the superficial, let's say, view. But obviously we've seen, a lot of, let's say, market bubbles when people were buying a lot of things and it didn't end up to be, let's say, the right decision at the end. So I guess the question is like maybe, to go a little bit more beyond, let's say, the superficial, let's say, view of, let's say somebody's buying and somebody's selling, right? And even when companies raise primary rounds, obviously it sends basically signals, but then it really depends what are they raising money for, right? Are they raising money for only because they can, because the market is hot and it can be raising money? And then, the question is for the investors, well, should they be investing at that time? Because probably the price is just too expensive at that point. But they may be raising because, they have good growth prospects and they need cash or for the growth prospects. Or they can be raising only because they simply need cash because they're running out of cash. And the equity round is basically a rescue equity, right? So it really is about kind of actually, let's say, looking beyond the first signal of basically somebody buys and somebody sells, right? And then it also, as on the primary, it depends then like on the terms and not just the price, but also, let's say, all the nitty-gritty terms of the deals. So for the secondaries, it's very similar. And going back to Matthias's point, right? So companies are really staying private for longer, right? In the old days, it was kind of like unheard of that a company that would be still, let's say, cash flow negative would have any secondary done on them because all the money just needs to go into the companies. But if the companies are really private for, let's say, 15 years or basically 10 plus years, then you have the ironic thing that, like you can have a founder that on paper is worth a lot of money, but actually struggles to get a mortgage, right? Because, or basically struggles to have their own house. And the funny thing is that, like, if you are building a company for basically such a long time and your wealth is completely concentrated in this one illiquid position, right, that you've built over 10 years, maybe even your decision making is skewed by that very feeling. So therefore, releasing a bit of pressure, and I think that was the phrase that was here used a few times, and I completely subscribe to that. Basically, releasing a bit of pressure, getting a bit of comfort, let's say for the founders at home, and to be really focused on building the companies in the future. That's no bad signal in that sale at all, right? So it really depends on what is the situation. And I guess one of the things is that when we look at secondaries, we look at the motivations of the sellers, and what we almost say that we want to buy from people who are motivated not by the health of the company. So basically, sellers who are selling because of a different reason than the health of the company itself. And the reasons can be multitude because simply life happens, right? So basically, there are good reasons and there are bad reasons to sell, like from the investor's perspective. And what is also very important is to understand, let's say, how much of the total position, especially if it is about founders, is actually still in that company, and how much there is still, let's say, continued alignment between investors and the people that are basically selling or, let's say, staying on in the company. So I would say I wouldn't put, let's say, restrictions on who can sell or who cannot sell, but more in terms of, let's say, how much they sell and how they sell. Like, let's say, what is the process? That is, I think, more important than the pure fact of basically selling. But would want to hear David's views on this, of course.
So I agree with everything you said, Lucas. I think, and I'll take this from a different point of view. When I was CFO at publicly traded companies, and the CEO or a senior member of management would sell, we'd get the question from investors, well, why is he selling? And the answer always was diversification. Now, it's especially true in growth stage, early stage companies where the founder, this might be his first job ever, and 99% of his personal wealth is rolled into one investment. So I do think that I don't think it's a bad signal when an investor sells 5, 10, 15% of his holdings, not of the percentage of the company, but of his holdings in the company, to diversify some of his portfolio and take some of the money off the table. And I think the investors in that company should actually embrace those types of situations.
Okay, well, it seems to be at least some alignment in this, and there was also a lot of talk, I think, about this, that let's say about the process and the organization of it. So if we go down the line, right? So basically, what should be the process? Because I think there were a few views that, okay, well, maybe the worst thing is kind of like completely ad hoc, basically sales, where people try to basically run around and sell their positions to like whoever they can on the street, right? So basically some kind of a process around it would be advisable, or I certainly agree with that. So just would want to, let's see, hear the views, or maybe Stephen, for you, right? So let's say, what kind of processes have you seen, or what are the processes that basically by which this should be done?
Yeah, I mean, there's a number of different ways, and it does depend to some extent on geography. But I guess at polar ends, you've got, on the one hand, ad hoc sales, exercises by employees at an exit event, or and nothing in between. But then, as you get through this process, obviously the idea is to relieve some of that pressure. So, as an employee comes up and says, look, I need to get a mortgage, or I'm getting married, or I, need it for school fees, or whatever it is, that companies then try and find somebody to take the shares. And normally that's an internal person. And normally it revolves around lots of emails flying around trying to find somebody who might want to take some exercise shares. And I think our learnings are that, generally speaking, that's not a great way for a company to operate. And what's much better is for there to be a sort of coordinated, whether it's an annual event, whether it's, as David said, maybe linked to a primary event, but something whereby everyone can be signposted well in advance to say, look, there is an opportunity for people who have some vested shares to realize some cash. It may not be at the last round price, and we'll come on to maybe pricing later, but it will be sufficient for people to raise some cash through the option exercises, and the company coordinates that. And we're certainly seeing a move down that path of more coordination. And I think as much because companies don't want to have, as they've gone longer, they've also got bigger. So you've got more and more employees. And so having lots of, ad hoc emails going around to various existing shareholders or to third parties saying, would you be interested in small pockets of shares, isn't very attractive. So we're almost moving de facto to a position where now most companies think about this in some sort of program type concept of building a program that people can signpost to their employees. It almost becomes, ironically, it almost goes back to what David said about people being tied in for the long term, because people think there is some ability to realize something. That does almost tie people in, because then your employees then look at the business and say, well, do I really believe in this business? And actually, if I really believe in it, then I am motivated to retain my stock options, but I appreciate the company's making efforts to allow me to realize something. So it does actually take the employees back to think about why have they actually got the options. But that sort of coordinated program is definitely the move we're seeing, and sort of has been the direction of travel for, I would say, the last 12 months or so.
David, how about you? What's your experience? Have you had these situations? What was it? Organized process within primary, or sending out emails, to people?
So the sending out emails to people is a problem. Determining the price is a problem. If an employee makes a deal with an investor, one of them has all the information on the private company, and that would be the investor, and the employee does not have the information. So it's kind of a lopsided transaction where the employee might, in the end, get hurt, because 6 months later they might sell the company for 10 times what he sold his shares to that investor. So that's why I'm a big believer in trying. Look, growth stage companies, especially since when they're around for 10 or 12 or 15 years, they've gone and raised funds a number of times. More than 3, probably close to 6 sometimes. And if every 2 or 3 years there's a secondary sale and the employees know that the next time the company raises funds, they're going to be able to participate, I think that's fair enough. I do believe that if it's not connected to a primary round, then the investor will come along and ask for information that the company needs to sit down and prepare. They have to agree on a price. The price is not set by a third party, investor who's doing the transaction. If it is connected to a primary round, the data room is ready for the price is determined as a derivative of the preferred shares issued in that round, and there is additional work that needs to be done by the HR department and the finance department, but I think the process is much more straightforward when it's connected in tandem, close to a primary round.
Yeah, thanks. Maybe yeah. You go on, Matthias. Yeah.
Jumping in here and react. I think it's a completely fair point on the amount of work involved for companies, and so I appreciate why time work that's already been done for the primary makes sense. Curious to know what all data seems to point toward has slowed dramatically. It's not entirely clear when the next rounds will come. And so communicating to employees about when both the primary and hence the secondary, the next window will be, seems a lot more complicated. And so I'm curious to know how you're navigating that at Guesty.
I'm not specifically to Guesty, but let's take the funds. We all saw these tremendous rounds of funds that were raised by companies, growth stage companies, early last year and the year before, at outrageously high multiples. So the price per share is really, really high. Does the company want to have sales of shares at a discount from the previous round? Will it affect the company's 409A? Will the employees start walking around and saying, "Oh my God, the company is valued less today"? These are issues that you have to deal with, and I think that the employees, if they do value their options, they should hold on and wait for the company to come back until the valuations come back. Right now, the valuations, as we look in the public markets, they're not getting the multiples they got in early 2021, late 2020.
That's a fair point. Obviously, and that's probably for another SaaS Lounge is like, will they ever come back to those same levels? And especially when, let's say, the notion of the day is for the companies to break even. So in a way to be, let's say, self-dependent in terms of their cash and not needing to raise primary money. So that's where even I would say, let's say, Matthias's question on, okay, should there be a visibility for the employees? And I guess that's kind of, I guess that's one of the key questions in this. Like, should this be a one-off or with the events, or should there be maybe like a regular process, kind of like a regular event, right? That basically almost, let's say, the employees know that, once a year, twice a year, or whatever, there will be a process organized. And therefore, they can, in a way, in their mind, plan even they're basically thinking about, let's say, liquidity and effectively their life, because that's one of these the things that we've kind of like heard, and that is also, let's say, creating, in a way, the problems in the value perception, is that ultimately in a private company, it depends on the decision of the founder, right? Like when the employees will be able to sell, right? And that can create a little bit of a, let's say, maybe the lack of transparency or the lack of, let's say, predictability of that can maybe create, let's say, the psychological effects that at the end of the day, people don't quite understand the value of their options, right? So maybe a regular event could, let's say, put a number to it, and they would understand the value. And ironically, and what we've also kind of like, let's say, heard and noticed is that sometimes people just having the option to do that realizes that their value is going up, and then they choose not to take it, and it already works as a let's say motivation factor. But I mean, I guess the key question there is, because there was a very valid point from David, because obviously if an investor comes in, they can't do it blindly. They need information, and organizing such a process is a strain on the company, right? And ultimately the company is not getting anything, right? Because the money is not coming to the company, the money is coming to the sellers. But it is a strain on the company, on the resources. So obviously there needs to be a process around it. So how can that process be arranged? Matthias, maybe too.
Yes. So again, here, full this is our core job at some.
The answer
I'm going to give
what we're doing. So I think there's one
solution, which is you need
market
and you need to come up
two difficult things.
If you're doing it in conjunction, both of those bits of work are done. You've negotiated your term sheet. There's a set price for your Series D, E, F preferred shares. You can come to an agreement on what the common is worth, and or in some cases, and here it'll be really interesting to get Stephen's point on, you can convert the common into the last round preferred, because that seems to be common practice with a lot of companies, for good reasons or bad, or bad. I think it'll be interesting to get everybody's take on that. But that's one solution, is just to say primary, we take that price, we take that information, and we just run it in parallel to the process. The company are typically valued north of 500 million. They've been around for at least 6, 7, 8 years. Usually, they have internal accountability with their board and their existing shareholders, which force them to produce recurring basis that is very close to what you would expect from fundraising material. So from, up-to-date cap table, some kind of corporate narrative. And so what we found is that the amount of work when you take last material plus what's been prepared for the boards in between to actually move to something that secondary investors will accept to run their due diligence is usually not the time-consuming aspect of it. The really time-consuming aspects are, one, running with investors, which we take. So, we understand that companies aren't staffed to run a year, or even maybe one transaction a year for their employees. And so we've built the infrastructure to do that. The other thing is helping them execute. And there's solved. In some cases, it's only a handful of employees in one country and it's easy. In other cases, it can be hundreds of employees in dozens of countries, and there it can be a lot more heavy operationally to execute. That's one of the things that Stefan was referring to when he said quite messy from a legal and tax perspective if you let everybody do it in their own corner. And so that's where we think that bringing the company in the middle is really important, but at the same time, they don't necessarily need to be ones doing all the heavy lifting, and that's what we're trying to provide to them. And curious to get both of your particular, I'd love to get your impression converting to common to be a recurring conversation when
You mean to prefs, right?
common to pref.
Yeah. So maybe Stephen, your take on this, and how common is that, and also I guess the execution pitfalls in performing, let's say, a program like that, and let's say the share buyback like that.
Yeah, I mean, I think as I touched on, every geography has slightly different nuances around how they do share transfers and who can hold shares. So I think part of the idea that you can take away some elements of that, and I think mostly it's the investor link, because I think the secondary investors are probably a different group of people compared to investors that the company would necessarily be looking for primaries, albeit there are some important considerations around who is coming onto your cap table, which is a point we haven't really touched on yet, but that's obviously a big consideration. So, it's no good to allow somebody to go off and, take a whole group of investors from Russia, for example, because clearly that has serious connotations for one reason or another that we're all very familiar with at the moment in time. So I think that's a different piece that we should maybe touch on later. There's no doubt, I think, that where the market started, that the people who were interested in doing on the investor side, who were interested in coming to this market, a lot of the initial sell to people was very much that this is common stock, and you're going to probably get some price differential, but you're coming into a company that you wouldn't ordinarily get access to, and that was the attraction for people. And I think it's probably fair to say that over the last couple of years, we've seen the more sophisticated investors start to realize that actually there's another way to get access to companies, and part of that is through these secondary offerings, but that the quid pro quo is that they don't want to be sat at the bottom of the waterfall, they'd like to be sat at the top of the waterfall. So it's definitely a balance. It's probably, I would say, outside of the pricing, which actually surprisingly hasn't been as contentious as you would think. The biggest issue has been those groups about whether they're comfortable moving people up the waterfall by giving them a conversion into the last round share, as opposed to staying at the bottom of the waterfall and being in the common stock. And that's definitely, and there's no sweet answer to which way you go. Clearly, from a company perspective, to some extent, whilst it's preferable to help the employees, on the other hand, it's also preferable to keep people in the common stock, as opposed to having more people trying to jump up the waterfall, because that just adds more complexity every time you then do another funding round. So I think that's definitely it's going to be a continuing theme, I think, in terms of what happens in terms of that movement. I'd say probably it's in the sort of 40 to 50% of times that we see people say we actually want to get into the most senior ranking share, and it's definitely become more prevalent over the last, I would say, 6 to 9 months, that we're definitely seeing more people. That's the sort of starting point for people, is they're not just happy to accept common, they want some element of moving up. I think most secondary investors will accept some common, so there's not an insistence that everything has to be at the top ranking share. They understand that there's an arbitrage there between the class of share and the price they're getting, but there's definitely a push now for that movement to be higher up the waterfall.
Thank you. Yeah, David, your views on that, maybe?
So specifically for Israeli-based companies, the conversion from common to a preferred share creates a tax event, takes away the tax advantage that an employee would have. The limited taxes that he pays on his sale of his options. It's a big issue, and it could affect the company, because the company should have been withholding the tax on that in a different manner, and it doesn't happen instantly, and the tax authorities can come along at any point in time and say, later on, 2, 3, 4 years later, then go grab back the. So it could have, in Israel specifically, it could have tax implications for the employee and for the company. Major. I mean, the employees pay 25% tax on the sale of their options if it's in a 102 plan, and they could be paying north of 50% tax if it's ordinary income for them. So, and the company could be liable for that difference. That's number one. Number two, if I'm an investor in a company like this, and I'm not the one purchasing the secondary Series A or B preferred, I might not be happy with letting employees jump and sell their shares as a preferred share, and come ahead of me in the waterfall and jump onto Series E. That might be not acceptable to earlier investors. And the third thing is, I'm an early investor in the company. I'm on the board of this company, and by preparing this, allowing it to be sent out to the secondary investors. Stephen, you would have to talk about this. You'd know more about this than me, but I am creating a liability for the company where the company has no upside on that part, except for maybe keeping the employees happy. And again, that's why, I'm starting to sound like a broken record. I keep going back to, if there's a primary round where we're already incurring the liability and we're already printing documentation, it does make life easier for the company.
Or And of course, I will now basically drive a little bit, let's say to my own corner is that, or have secondary investors on your cap table so that you don't need to go out and, like you have actually, because in a way, because what we said that like, what is the problem for the companies, the engagement and the process run with the investors, right? And then there is also this, let's say this perennial question is that for these kind of sales, should the company or the employees go and look for outside investors, or should they basically keep it in their, let's say, close circle of friends, right? So obviously, I guess there's basically two dynamics. If you keep it close, maybe the pricing would not be the most efficient, but on the other hand, you have a more limited process, and ideally the investors already know the company very well, let's say over the years, and don't actually need any extra information and can decide basically quite quickly, right? So let's say that's also maybe like a, let's say a consideration in the whole process, and would be interested to maybe let's say from Matthias's perspective, right? So obviously you are creating a platform which is going to say enabling these sales. How do you deal with, let's say, the problem? And of course we need to mention it, existing investors do have ROFR rights, right? Usually, I mean, it depends, but let's say they usually do have that. So how do you go around that, or basically how do you see these issues, let's say, offering to existing investors versus running a wider process? Because I can imagine that a company might not want to, let's say, like have a control of who actually gets their information in a certain process, right?
I think that touches
earlier,
which
is
is you want to control who ends up on the cap table. That's, I think, something that's quite dangerous if take
the secondary process
seriously and kind of into their own hands. It's motivation that we had when we built Semper. So there was companies want to keep who can sell, who can buy, and in what conditions that's done. And in the same way, they want to share, they want to control who gets access to what kind of information. And so at every, we have a pool of investors that we work with, but it's not only work with institutional investors ranging from family funds.
Company, you control who gets access
to each stage of the. Some investors, because they're in jurisdiction, like the countries that, because they're invested in some of your competitors, you can decide to, and then when we, through the process,
come up with offers
at the end, you end up as a
who gets to do the deal,
and so you keep full control. For the question on, do you open it up to outside investors, or do you keep it internal? Obviously, if you can get a good price from existing investors, the incentive to go outside is very limited, because to David's point, it's more work, it's more potential liability, and it's information dissemination, which you might not want if you're a couple months away from preparing for a primary. What we've seen in this market, to go back to, is that the most recent investors, those that 2020, 2021 price, are in a bit of a complicated situation to secondaries, because Series EF preferred at very high prices, and you have common stock come to them saying, hey, we'd like to sell you some of our common stock.
Stuck in a bit of a
complication where, given where it's at right now,
to those common stockholders are really, really low.
But if offers and they buy it at that really low price, they're Series EF preferred shares. And so with a lot of these investors, as they're saying, we can't really dedicate time to this, it's a much easier pricing conversation, not just with the company, but with their LP. They're a lot more open than they would have been 24 months ago, where the only thing on anybody's mind was, how much paper can I be buying? So it's a very interesting moment in the secondary market because of that. TBD how long it's going to last. But right now we're seeing virtually, apart from, I'd say sub 10% of companies are kind of their secondary processes to existing investors. But would be great to get both David and especially on Steven's angle, that he has access to some data that he won't share on the deals that we don't even hear. So it would be great to get your sense of that.
But I guess a part of this is also maybe, let's say nobody wants to be the bad guy. So like that's why, let's say the rollers kick in. The existing investors can just wait on the sidelines, let basically somebody else to price it, and then if they like it, they take it. So I guess that's I guess the question. But obviously then basically existing of the rollers then limits the appetite of the third parties, because nobody wants to go through the whole length of the let's say the investment process to only let's say 5 meters from the goal to then be offered by existing investors. So Stephen, maybe to you, like what would be the best practices around this, right? Because obviously these are, like you can't ignore existing investors. You can't not give them the rights, right? On the other hand, this can be a real issue in these kind of processes. So what would be the best practices, or what have you seen being done?
Yeah, I mean, look, the companies where this is work, I mean, generally speaking, I would say, not wanting to take one side or the other, but I think most investors do not get to a point where they go all the way down, let people go down the track, let companies go down the track, and then at the last minute go, actually, no, I think we'll decide to take those. Thanks very much for doing all that hard work. I think the investor base has got a lot more sophisticated, and they just understand that actually that sort of practice just doesn't happen anymore. People just don't do that sort of behavior. Certainly for institutional investors, they're just not in that mode. So I think if they want to buy the shares, they'll say up front, we'll take the shares. But I think they're actually, in terms of what companies can do, it really goes down to the sort of transferability of shares, because obviously if companies have sort of legal docs that we would expect to see, sort of NVCA style, BVCA style documents, they're normally transfers. There's normally a board approval for transfers with some sort of investor director consent. And that's, certainly when we advise companies, say, look, you don't want to be in a position that you have to go back to your whole shareholder base to ask for a transfer of a small pocket of employee shares because you haven't thought about your documents. So, we would always encourage people to use, that sort of standard form type documents, which give the board the flexibility. And if the board thinks this is a good idea, then, it really is for the benefit of all employees, because the board is saying to shareholders, look, we think this is the right thing for the company to do. And we've got a mechanism to do that, where a board approval with an investor director or investor directors present at the board meeting can effectively say, yes, look, this is a good deal. Therefore, it can sit outside that sort of preemptive right that existing shareholders have to buy more shares. And it's normally linked to sale of employee shares. And so that's what we're sort of seeing, and certainly the sort of those documents would allow you to do that, and that's obviously the best position. If you haven't got those sorts of rights, then obviously you've got to then change your bylaws, change the documentation to allow you to then go out and do those secondary transfers, which is just more problematic. And from a sort of PR and cosmetic perspective, people don't like to do that. So if you can get the document set up in the right way initially, that's certainly preferable. And certainly for bigger companies, they tend to have that flexibility.
David, what about you? What would be your preference, close circle of friends or wider processes? And what have you seen from your existing shareholders in terms of, appetite for let's say secondary deals and them applying their offer rights?
So again, I'm not going to speak specifically about any specific company or what the shareholders are doing, but when markets are volatile and prices move around, secondary shares, sale of any kind of substantial secondary share can affect the mark to market that some investors need to employ. And you might not be doing your investors a favor by allowing employees to sell at a discount to what the previous round was and what they're currently holding it in their books. Most companies that I've been involved with, the transfer shares needs, as Stephen said, you need a board approval, and the board could say, no, we don't want that person on the cap table. Have a nice day. And as far as Matthias, as he said earlier, you don't want your documents running around all over the place, and you just don't want to disseminate that kind of information. So the processes that I have seen or that I've advocated for were almost always connected to a primary round. I was in one unfortunate situation where a senior member of management passed away, and the family had a certain amount of time to exercise and sell the shares, and so it was taken on by a recent investor in the company, bought out the shares. Otherwise, it would have been a difficult situation to go out and try to sell those shares to a third party. Again, I said it before. I'm starting to sound, I'm repeating myself, but secondary shares, I think secondary sales are important, need to be limited in the percentage that someone can sell, and I would prefer to see them set up together with a primary or near a primary sale, so to limit the amount of exposure and work that the company has to incur.
Understood. There's also one notion that has been mentioned here, and that was. I'm sorry again. Yeah. There was just one of the notion that was about the repricing, or basically the discounts, right? So. And obviously that's a big question on the secondaries. How are they priced, right? And clearly there is a differential between, let's say, preferred shares and the common shares, and the I mean, like when we talk to people, we always say that basically there is, in a way, let's say, two sorts of discounts. One is the discounts for illiquidity, because you make immediate liquidity for basically something that is illiquid, right? So like that has a price. It's kind of like a time value of money, right? And the other one, but that's more kind of like a market. If there's more demand for a certain paper, then basically there's a small discount or to no discount, and there is where there is kind of like a mismatch between the supply and demand that basically kind of like stretches. But there is another source of discount, and that is a structural subordination, and that is also what we basically touched upon, right? So let's say being let's say rounds raised at very high valuations, that means there is a very high liquidity waterfall already embedded in that company. Therefore, it really depends on where you sit on that waterfall. We personally, I mean, like we in Flashpoint actually spend a lot of time especially analyzing that, kind of like how much, in a way, liquidity leverage is that on the company, because that's how we effectively see it, right? So but then so there is a lot of complexity in basically pricing secondary deals. But it would be interesting to hear both from Matthias and Stephen that, let's say, what have you seen in terms of how the prices have been established in the processes that you've been part of? So maybe Stephen first, because I see Matthias was still muted.
Go, Matthias. No, I think Matthias, you go, and I'll happy to chime in afterwards.
Sure.
I'm happy to go either way. So on pricing, I think you're absolutely right. I think I'd say there's two. You said two discounts on fair market value. I think is the last thing that was missing on the sentence, because one of the things that we've seen is companies not necessarily appreciating the fact that fair market value is not necessarily equal to the last round price. And multiples have contracted, and it's David is right. You might not be doing your investor by forcing a downward mark to market. The reality is that what we tell companies is you mark yourself to market right now, but the market is still keeping tabs. Yeah, they may not have the exact, but they're estimate of what they think you're worth, and that's not necessarily the last round price, even if you haven't done a transaction since. In terms of this, what we're observing, there's definitely been a big shift to the buyer's market, the result of a lot more to sell and a lot less people, like a lot less actors in the ventures and growth space than there was a year and a half ago. Not that they exited. I think they're still keeping tabs on a lot of companies that they like, some of which they're already invested in, some they did invest in the past, but would look to, within the near future. But the vol do call for quite a bit of caution. And so we're seeing a lot of people not completely depart, but, just sit on the sidelines. And that's obviously had a big impact on pricing. Right now, what I usually tell founders or before they give me access to any of their information is, an easy way to look at it is the market's down 50%. So you take whatever last round, take 50. And then if you're doing particularly well or in a sector that's getting, still quite investor attention, be in a very good position if you end up at 20, 30. So subsector that's, taking a bit more pain, especially if you have a lot of public comparables, you might be looking at 60, 70. And that's, the broad brush that everybody gets painted with at the moment.
Yeah, I think you're right, Matteo. Look, there's definitely a discounted element. I think probably a couple of observations. I think we've touched on this. A few people have mentioned it, but every geography has particular requirements for employees. So for some geographies, they have to sell shares at market value. But as Matteo said, market value doesn't mean last round price value. And I think most companies and most investors accept that a pocket of employees selling shares as part of a coordinated secondary transaction is not something that is going to be looked at as being an issue from a fundraising perspective at the next round. I think most sophisticated investors, and by the time most of the companies we're talking about have been through A, B, and are definitely into C, D, E, F, or no doubt we're going to see GHs and who knows beyond that in the current climate. But I think most investors understand that we're talking about relatively small number of shares, and there's not a huge amount of mileage in saying, well, actually, you let some employees sell some shares at a significant discount. Therefore, we're only going to be looking at a smaller round or a smaller up round than we were seeing before. Although, frankly, we know what the mantra is about flat rounds and up rounds at the moment. So who knows where that goes? But I don't think that's particularly a big issue for incoming investors. I think the other piece I just thought I'd mention was that I think the coordinated, whether it's annual, biannual, whatever it might be, process, I think is helpful, because I think what you can't do is do things late on in the process. So you certainly don't want to be doing this in the run up to an exit or in the sort of prep phase for an IPO, whether it's NASDAQ or a European jurisdiction or somewhere else. But I suspect most companies are probably thinking about mostly NASDAQ, and so if I that's probably my best example of you certainly don't want to be doing this sort of in the 3 months for the run up to an IPO, when we have to sort of think about cheap share type issues, that discounted shares, etc., and what that means at that point. So having this sort of coordinated signposting is sort of helpful from that perspective, because it means that then there is an opportunity beforehand, because it can sometimes be quite difficult for companies when they say to the word gets out, which inevitably does, that the company's thinking about an IPO, and then before you know it, everyone's knocking at David's door going, David, I hear we're IPOing, I want to try and sell my stock now, what do I do? And he's inundated with a line of people trying to sell their stock. So I think there's a process to get through when you're thinking about what that exit route looks like.
Thank you. So look, we have about 2 minutes left, and we do have one question from the audience. And if I would actually, so I want to kind of answer that question, or basically give, let's say, people the chance to answer at least quickly. If I would paraphrase it, is that what about small firms? Or basically, is there almost kind of like a threshold for a size of the firm for which this would be applicable? I guess, maybe I can ask David about his, let's say, what his view would be from a company perspective, and then I guess Steven and Matthias more what they have seen in the market as a practice.
Lucas, I don't understand the question. Sorry, apologize.
Okay, so well, basically, should the companies, let's say, enable this, or basically have, let's say, a secondary sales, even when they are small companies, right? Let's say, in the earliest stages of development. If I would put it in the language of, let's say, venture capital, let's say Series A, B companies, right?
I don't think so. I think it's too early. I think employees have to have some patience with the company to see where it's going. I would not advocate to enable secondary sales that early in the lifetime of the company.
Thank you, Stephen and Matthias. Just like with the a few time that we have left, just like what have you seen as a practice in the market?
Yeah, I mean, I agree with David. I'd say you don't want to do it too early. It's a defocus. The company internally to do it, and to be honest, there wouldn't even be demand because
Deals
are
complicated enough
for late stage companies. Very early on, there just really isn't,
and so you'd be spending
a lot. Ultimately, would be very unlikely.
I see Stephen nodding, so kind of agreeing. Or do you want to add something?
Nothing to add.
Okay, perfect. So I think we're just on time to basically finish this. So, gentlemen, thank you very much for joining. It's been a pleasure. Really appreciate it. Hopefully, the audience have enjoyed it as well. Thank you.
Thank you, Lucas.
Thank you very much.
Thank you.
Everyone. Take care.